Okay, we're going to try and stay calm tonight. So tonight I'm going to look at what happened in the markets last year. We're going to look at what we expect this year in a framework we're calling market madness. We're going to use the same framework to look a little bit further out, and finally we're going to look at some investment ideas. So what happened in markets last year? It was actually a very good year in all asset classes, especially equities. You see US equities up almost 32%. The fixed income market up as well. Credit did very well, and even commodities, with the exception of industrial metals, did very well. Now, this is actually the mirror image of what we saw in 2018, when almost everything was down. And in fact, some of the gains we saw last year was likely a recovery of a bad 2018. But still, overall, a good year last year. And it's actually been a very good year, or actually been a very good decade in recovery in this bull market from the financial crisis. We can see that stocks have done very good over 10 years. So US equities, almost 14% annualized return over the last 10 years. Usually you get about, on the long-term average, about 9%. So well above average. Canadian, European, Asian stocks, not quite as good. Fixed income, again, reasonably strong. Credit, very good, almost equity-like returns. Commodities, a little bit more mixed, with only gold in positive territory. You know, it's not only financial assets that have done very well, but also some luxury items. And Knight Frank compiles a composite of luxury items, and you can see how well all of they have done over the last 10 years. In fact, only Grandma's old dining room set has gone down in value. Now, the highest returning item, I haven't put it up here yet, even better than US stocks, was rare whiskey. Who would have thought investing could be profitable, fun, and tasty? So we want to look at the S&P in a little bit more detail because it was a good year, almost 32%, but it wasn't straight up. And in fact, you had two rallies around a sort of a middle patch that was actually fairly volatile and was influenced by monetary policy from a positive point of view and the negative aspects of the trade war between the US and China.